Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. How has your portfolio done over the last 12 to 15 months? Well, if you're a small cap investor and you're up 70% to 80% in the last 12 to 15 months, then you have done an average job. Yes, that's correct. A return of 70% to 80% in recent months does not qualify you as a great investor. Why? That's because even the BSE small cap index has returned more than 80% in the last 12 to 15 months. You have underperformed the BSE small cap index if you have generated return of 80% or lower. But if you've got these returns from a portfolio of large caps, then you are a genius. This is because the large cap index, that is the Sensex, has returned only 33% over the last 15 months. You see, outperforming the market is not easy, especially over a 5 to 7 year period. The 5-year CAGR of the Sensex is in the region of 14% to 15%. Therefore, if you've not earned at least 5 percentage points more, that is a CAGR of 20% over this time period from large caps, then you won't be considered a great investor. The BSE small cap index has given an impressive CAGR of 28% over the last 5 years. Thus, if your picks from the small cap space have not compounded at a rate of at least 33% to 35%, then once again, you are not a great investor. You will have to be content with being an average investor or try becoming a great investor by adopting a different strategy. Do you know why Warren Buffett and Peter Lynch are considered great investors? Why are they legends of the investment world? Well, simply because they have earned returns that are significantly higher than the benchmark index over a prolonged period. Take Warren Buffett for instance. He has compounded money at a CAGR of almost 20%, while the US benchmark index has earned only 10% CAGR. Now, if this is not astonishing enough, Buffett has managed to maintain his edge over a period as long as 60 years. Let that sink in. For almost 6 decades, the Oracle of Omaha has managed to keep the benchmark index at bay. Truly a great investor by any stretch of imagination. Although Peter Lynch's period of outperformance lasted only 13 years because he decided to retire, the magnitude of his outperformance is also quite impressive. He has also done twice as better as the US benchmark index. Back home in India as well, there are many investors who managed to outperform the index by at least 5 percentage points per annum over a very long period. But what makes investors like Warren Buffett and Peter Lynch great? What is the secret sauce? I recently came across an article by Howard Marks that threw some light on this puzzle. Howard Marks has argued that truly successful investors are neither overly aggressive nor defensive. They excel at both market timing and picking good investments. Let me repeat that. Great investors strike a fine balance between aggression and defense. They correctly adjust the market exposure at the right time, and the stock picks are such that their win-loss ratio is much better than most of the investors. You see, one of the reasons investing is hard because it requires a quick mindset shift. 1 minute you are defensive and the next minute you may have to turn aggressive. And it is this shift that takes a toll on most investors. One must be prepared to change one's mindset at a moment's notice. This is why I love Warren Buffett so much. He has this remarkable ability to go from one mindset to another. He will stay defensive not for days or months, but for years together, and then suddenly when the opportunity presents itself, he will rapidly turn aggressive. And it is this quality that is largely responsible for making him such a great investor. Therefore, if you want to be a great investor, you will have to be neither overly aggressive nor defensive. You will have to look at the broader market, the sentiment, the valuations, and then take a call whether you should be aggressive or defensive. And of course, you will have to be ready for a mindset shift at a moment's notice. So that's one of the qualities that you need to be a great investor. Now, Warren Buffett is all about individual stocks. He uses his aggression defense mindset extremely well for picking great quality stocks at attractive valuations. However, you can apply this skill to the broader market as well. You can try to be a great investor by adjusting your market exposure based on the broader market valuations. Let me explain further. You see, in the 21st century so far, there have been 11 years where the Sensex PE ratio or the price to earnings ratio was below 20 times at the start of the year. Let me repeat. There were 11 occasions in the last 23 years when Sensex was trading at a PE multiple of 20 or lower. And the average return the Sensex has given over the next 1 year is 29.2%. This means that taking a large exposure to stocks when the Sensex PE was 20 times or lower would have proven to be a good decision, as it would have given you an average return of 29%. Now let's take a look at another chart. As you can see, there have been 8 occasions since the year 2000 where the Sensex had a PE multiple of more than 22 times at the start of the year. Therefore, the average return when the Sensex has traded at a PE of more than 22 times at the start is a poor 3.9%. Sensex has earned only 4% on average when the starting PE multiple has been more than 22 times. And finally, here is the chart where the Sensex PE multiple has been between 20 and 22 times and the average return has been 5%. Here's the takeaway from this study in one table. The quality of a great investor is to know when to be aggressive and when to be defensive. So if an investor has rupees 100 and he has a portfolio of stocks and bonds, then I think it will be a great idea to turn aggressive and invest rupees 75 in stocks when the Sensex PE is below 20 times and the remaining rupees 25 in bonds. Likewise, when the Sensex PE goes about 22 times, he can do the reverse. That is, he can turn defensive and have only rupees 25 in stocks and the remaining rupees 75 in bonds. And when the Sensex PE is between 20 and 22 times, he can be 50-50. Right now, the Sensex PE multiple is 23 times. This means that it is perhaps time to turn defensive and take a meaningful sum out of stocks and into bonds. Now, what are the kind of stocks that one should invest in? Well, you should have a portfolio of 25 to 30 stocks where not only is the business quality decent, but the valuations are also not stretched. In other words, no investing in stocks that are loss-making or have a lot of debt, or both. Also, the stock should either be trading at single to low double-digit PE ratio if it is a micro cap or a small cap, or a PE ratio of maximum 25 to 30 times if it is a mid cap or a large cap. Consider these basic filters and I believe you'll have a portfolio that is not only resilient but also has a good upside potential. Okay, time for a quick recap. You are not a great investor if you have not outperformed the appropriate benchmark index by at least 5 percentage points per annum. To be a great investor, Howard Marks believes that you should be good at market timing and should also pick winning stocks. Now, correct market timing involves knowing when to be aggressive and when to be defensive. Deciding your asset allocation based on the Sensex PE multiple has proven to be a reliable method of market timing. You can be aggressive when the Sensex PE is below 20 times and defensive when it goes above 22 to 23 times. As far as stock picking is concerned, stay away from bad quality stocks as well as highly expensive stocks. So there you are, a roadmap for a beginner for becoming a successful investor. Now, is success guaranteed with the approach that I have just highlighted? Well, there are no guarantees in investing. However, by following this approach, you will be forced to buy more after the market has fallen and sell more after the market has risen. And this is the right thing to do from a long-term perspective. Most investors can't even do this. they usually end up buying after the market has risen and selling after it has fallen. So this is definitely a framework to do the right thing from a long-term perspective. However, getting superior results from this framework depends on your own effort and the intelligence you bring to the table. Let me know what you think. I'll see you again in the next session. Goodbye and happy investing.